Okay children, now we are going to discuss about the 2016 A-level paper MCQ 7th question. So we are going to find out the answer with the procedure. So 7th question. Suppose X is an inferior good and sold in a competitive market. Assuming other things remain constant. In the market for X, what are the effects of a decrease in income of buyers on the demand, equilibrium price and the equilibrium quantity in the market for X? Here the way you have to know how to solve this question. First of all, you should identify what is the inferior good. Inferior good, you know, it is under the which elasticity? Income elasticity. So inferior good, under the income elasticity there is a negative relationship between income and demand. So you know the relationship like that. When the income increases, the demand decreases, and the income decreases, the demand increases, like that negative relationship it has. So here they mention inferior good, the decrease in income of buyers. When income of the buyers decrease means when there is a negative relationship, the demand is increase. That is why their demand increases. Then demand increases, you know, you also demand, I also demand, like that. You demand for 100 rupees, I demand for 500 rupees, like that. The prices are what happened? Increasing. So here that's why the prices are increases. When the demand increases, the prices also increases, because we like to demand more in different prices, because we need to take that good. When the price increase, what happened to the supply? Quantity supply is increasing. Why? Because you know there is a positive relationship between price and the quantity supply. That is why they supply more, because they like to, when the price increases, they like to gain more profit, they supply more. That is why the quantity increases. That is the way the relationships between demand, price and quantity, and the way of solving that question. Then 8th one. The table below shows the market demand schedules and the supply schedules for a good before and after the imposition of a specific per unit tax on an essential commodity. Here is the table. Price, quantity demand, quantity supply before tax and quantity supply after tax. Then you can see the quantity demand is not changing. It is 50 rupees each and every point. And we have to have the good sound knowledge to how to draw a demand and supply curve, the graph. So children, you have that knowledge, and then you have to draw the diagram. Then you can easily find out the answer. So through this table you cannot find out any answer. You have to draw the diagram. So you should do the more past papers, and you can have that knowledge, you can have that experience. So here the diagram you can see here, price and quantity axis, you can see price axis and quantity axis. Then you have to draw the diagram. The demand curve you can see it is not changing, it is 50 rupees, 50 quantity, it is not changing. Quantity supply 50 in the demand, and the supply curve S1 and S2. Supply curve S1 means this is the before the tax supply curve, and the equilibrium price 15 and equilibrium quantity 50. And this supply curve, this is a tax. After the tax, the supply curve shift to leftward, because it is a disadvantage thing, and supply curve shift to the leftward. Then the price is, equilibrium price is 17 and the quantity is 50. Children, you have to know when you draw the diagram, there is a tax. How to find out the tax? So you have to know the equilibrium quantity after the tax, where the place the before supply curve intersect. So this is your equilibrium quantity after the tax. Then here goes, and this is the place the before supply curve, before the tax the supply curve intersect, and the price here you have to know, find out. Then 15 to 17, between the equilibrium price and the supply curve cards, here the intersect, here it is the tax. So 15 to 17 is the tax, that means 2 rupees. Okay, that is why it is 2 rupees. So when you draw the diagram, you can find out the answer. Then ninth question, the price elasticity of demand for ballpoint pen is minus 3.0. When the price of a ballpoint pen is 25 rupees, quantity demanded is 300 pens. How much will be demanded when the price falls to 20 rupees? Okay. When you solve this question, children, you have to simplify the question. That is important. Then you can see the answer through this one, through like this question. So this is the way I simplify the question. That is, price, it is, they mentioned 25 rupees and at that time quantity is 300, and then price reduced to 20 rupees. So this is, we are going to find out this answer. I am going to explain how to find out this answer. So then there is a, they mentioned price elasticity, so it is minus 3.0. Children, you have to know the elasticity equations. There is, when there is a percentages, you have to take the percentage equation. So there is no percentages, so you have to take the point price elasticity equation. That is, the cross price elasticity of demand is the delta Q divided by delta P into P divided by Q. That is the equation. Then add the amounts according to the equation. That means minus 3.0, that is the elasticity. Then delta Q divided by delta 5, 25, 300, like that. Okay, delta Q we don't know. So the delta P here, they mentioned 25 to 20, it is 5. Okay. Then the price 25 and the demand 300. We add like this. Then when the question solving, the answer is 180. That means minus 3 you don't need to consider when you do the calculation. I know that you have some question, what happened to the minus. Minus means here they mention the price and quantity demand has the negative relationship. That is why we add the minus to show that one. And the quantity is delta Q is 180, that is the delta, the difference. So add the, here you know, minus means negative. So price decreasing, the quantity should be increasing. So add the 180 to here and it is 480. That is the way of solving this question. It's easy. The next one, 10th question. The market supply curve for some good or service would shift to the left when technology improves. Market supply curve for some good or service would shift to the left. Children, in economics, normally disadvantageous things happen. The supply or demand curves shift to the left side. If it is advantage thing, the curves shift to the right side. Okay. Here left side. Technology improves. Technology improves is a advantage one, because when the technology improves, they can supply more. That means supply more goods and services, can supply more goods and services. The supply curve shift to the rightward. Then the prices of input falls. Prices of input falls. What are the inputs? Land, labor, capital. If you are a supplier, you know the prices of input falls means you like to supply more because you can gain more profit. That is why you supply more. Okay, then shift to the right side. Then prices of inputs increase. What happened? Prices of input increase means land inputs are the land, labor, capital. Prices are increasing. You cannot take the more profit because the cost is high. Then the supply, you decrease the supply. The supply curve shift to the leftward. That is the answer. The supply curve shift to the left side. Technology improves and the price of input falls. What happened? So it's also like that, before we discussed about that. The supply curve shift to the rightward. More supplies enter to the industry, so that means the goods and services supply more, they produce more goods and services. The supply curve shift to the rightward. Okay. Children, that is the way of solving the question.